Assalamualaikum warahmatullah everyone. Welcome back to our program on Islamic finance. Of course, there are many happening today. So one of the interesting development in the USA is the run on Silicon Valley Bank, SVB Bank in Northern California. I think some of you may have followed the news and some of the literature, and there's lots of commentaries in the Bloomberg and CNN, NBC, and many other channels or network that we can look at the comment from the experts. But for my part today, I would like just to look at some of the area where the Islamic perspective can be given, and this is where we come from to provide an analysis on the Islamic dimension of the situation. Of course, you know very well that the Silicon Valley Bank is a commercial bank, and they are basically have quite a number of branches all over the global market, but the one that is in trouble is the one in Silicon Valley. And one of the unique thing about SVB is that they receive a lot of deposits from big corporation, startups, and venture capital company, and the amount of deposit was quoted at about $170 billion. So these are not working class deposit like people like us, where we have $10,000 or $5,000 or $20,000, all of which are covered by the FDIC insurance. But most of this deposit, actually, 97% of the deposit are not covered by FDIC because these are big ticket deposits. So the problem here is if there is a run on the bank, and if this deposit leaves the bank in a very big way, as what we saw that has taken place, then that is where the problem began. And as we know that the Feds have been raising interest rate to stop inflation. They are targeting inflation at 2%, and they are still trying to go to hike it up in March in this month. But then this SVB run would, I presume, would cause the Feds to think about rising interest rate ever again. And what will happen, as you know, that inflation in the US has been very high, 7 to 8%, and many of these startups are beginning to withdraw their money, for payroll and to pay for the higher business expenses. And as many of these companies are withdrawing their money for good reason, to maintain their business, then the bank found out they don't have enough liquidity to pay for the withdrawals. The reserve requirement is very low. I think during the COVID-19, the SRR was reduced to almost 0%, and until now, it is still at that level, I presume. So not enough cash to pay for the withdrawals, and that has caused the bank to sell off some of their bond holdings. And as we know that rising interest rates will cause lower bond prices, and we saw in the news that SVB Bank has made a loss of 1.5 billion when they sell off their 21 billion worth of bonds to pay for the redemption. And these losses have been reported in the news, and this causes a lot of alarm. And many of the venture capitalists have advised their startup partners at SVB to start withdrawing their money. So then we can see that as many of these companies are withdrawing the money in a big amount, so there is a run on the bank, and the SVB are not able to provide the liquidity. They tried to raise capital, but again they fail, and this further caused a lot of panic. So this kind of run of the bank is very unique, not to be applied, or not to be compared with, or not to be contrasted to many other banks in the USA. But the main idea that we need to see from this happening is that, number one, that we have seen a default by a bank. The bank, SVB, is the borrowing party in the deposit market. SVB is the borrowing party. The depositors are the lending party. Now what we see is there is a default, meaning that the SVB are not able to pay the loan that they take from the depositors. Right? So it is an opposite, to what we see in 2008, where there is a default, where borrowers are not able to pay their loans to the bank. So there's a default on their loans. Now there's a default onto SVB. SVB, as the lending party, are not able to pay their loans to the depositors. And especially when most of the deposit are not covered by the FDIC insurance plan. But the idea here is that, the bailout that is coming from the US government is they are bailing out the big ticket depositors. They are bailing out the billionaires and the millionaires, who are the ones who are caught in the middle. So these are the big tech companies and big VC companies. And these are the ones that the US government will be bailing out, where these big depositors will be getting back their money, even though the bank has failed, to fulfill their, when the SVB has failed to fulfill their debt obligation. So there is a issue of morality. There's issue of the rich are getting richer, the poor are getting poorer, and this is not a good development. How the USA government is going to, rectify the issue, or to pay the 150 billion worth of deposits. This is again an issue that we need to look into. Of course, when we look at the the Islamic finance business, or the Islamic banking business, we don't see that kind of deposit market in Islamic banking. Most of the depositors are the working classes, and some are coming from big corporations, but they are not very concentrated like what we saw in SVB. At the same time, the exposure to the sukuk market, I presume, in Islamic bank is quite minimal, because as we know that there isn't much sukuk available in the Islamic capital market, and the Islamic bank are really trying to find, they're not finding enough sukuk to invest in. So this will not be a problem to the Islamic banking when it comes to sukuk holding or making losses from the holding of sukuk. Yes, I presume that it is a case that would not be hampering the Islamic banking business. But these are lessons learned. So meaning that we should be looking at the fact that the Islamic banking, as well as the conventional banking, is a highly leveraged business. The bank, with $1 of capital, with a leverage ratio of 3 cents based on Basel III, with $1 of capital, the bank will be able to borrow up to $33 of deposit in order to make loan, right? So banks simply need small amount of capital in order to borrow from the public in order to make loans. So this is not a possibility in a non-banking company. In a non-banking company, if you have a $1 capital, we will be using that $1 capital to do our business. So we are not able to borrow from a bank, to do our business based on $1 of capital. That's not the way how a non-banking company operates. But in a banking company, when you have $1 of capital, the system allow automatically the bank to borrow up to $33.3 from the deposit market, and using that deposit fund to make loan, right? So that is essentially what a bank is, and that is why we can see the huge amount of deposit funds, in the banking system. And when the amount is too much, the bank have difficulty to use, or the bank may have difficulty to find where to put the money in. Maybe for the case of SVB, they are not able to make enough loans because the demand for loan has been coming down to the higher interest rate, and therefore the only way for them to use the deposit fund is to by investing the funds in the bond market. Again, that is a concentrated investment, because a huge chunk of the asset were invested in the bond market. So we have concentration risk in the deposit market, we have concentration risk in the asset market, in the bond market. So these are things where there has been a weak oversight in the business model, and that has caused big trouble to SV, to the Silicon Valley Bank, as well as other banks in the United States. Okay, thank you very much. Please comment and share and subscribe. Assalamualaikum warahmatullah. Thank you.